Bring in Strategas Research Partners CEO Jason Trennert. It's better to take a breath and get it right because you're one of the biggest brains and one of our favorite guests on this program.
Wow. Okay.
What do you
No
make?
pressure.
What do you make of the earnings season so far?
Well, listen, I think you only have about 10% of the earnings of the S&P 500 reporting, but it's looking like 22% increase. I think there's a lot of people that are focused on the second derivative, which is to say that you talked about a peak in earnings in the first quarter, and I'm much more focused on just the level. And I think the good news is you're creating a lot of value, in my opinion, with the earnings that are coming in. And it's not just taxes. Even if in the first quarter earnings were up about 24%, if you stripped out taxes, they were up about 9%. So this is the real thing.
Yeah, earnings so far are up 23.3% from last year. That, again, analysts are looking for the estimates about 20.5, so 21. Christina?
Don't you think, though, that investment sentiment right now is relatively bearish, and then you mix that with the uncertainty for a lot of companies, so we could potentially be heading for a little bit of a downward trend over the next little while?
I have to say, from a short-term perspective, of course, that's always possible. But I also think if you're an intermediate to longer-term investor, the fact that people are concerned is a good thing.
Right.
This is a strange bull market because in many ways it's the bull market no one loved. People keep fighting it. And it keeps grinding higher. It's over 9 years old. It's 9 years old in 4 months or something. And I would say that the zeitgeist around the bull market, it's not cocktail party stuff. People are not swapping 3-letter, 5-letter symbols of stocks at cocktail parties. It's not like it was in the 90s.
No, because it's more hip. It's more hip to be in a fire-breathing rage about the latest Trump tweet, and not talk about the nuts and bolts of the American economy.
And I think,
by the way, jobless claims were at the lowest level yesterday since 1969, the year we landed on the moon.
Listen, it's funny, and the younger people, there's some younger people here, if they're going to be speculating, they're speculating on Bitcoin. They're not buying Jacobs Engineering, or they're not. I would say one of the other issues, and this is so many of our most exciting companies in the U.S. are now public companies. So the Ubers of the world, and so on. They've stayed private companies. So that's in some ways that's moderated the investment sentiment in a good way, because you don't have people that are all the way in. I think it's more of an issue for private equity, but that's a story for a different day.
Jason, one of the biggest things that I think has hampered the market is they don't know really what multiple it should be trading at. 17.5 times earnings, that seems fair. Would I want to put new money to work? I'm worried about operating margins because guess what? Financing costs are going up, labor's going up. So there's a lot of these concerns. Where do you think, the market goes from here? Where do you think a fair PE multiple is?
Listen, I think in the old days, this is a great heuristic, rule of thumb, which is the rule of 20, and you take 20 and you subtract out the inflation rate, and that's usually it. And we have very fancy, sophisticated models, and we have this one, and they're about equal in terms of how well they do. But so I think a 17 to 18 multiple is pretty fair given where inflation is, which would suggest that you're going into a period in which I think the bull market can last longer. It's just your earnings. I would say the market is going to get more in line with longer-term earnings trends, which, as we know, are more like 7 or 8%. You're not going to have. Last year was an extremely. You essentially discounted a lot of the earnings into 2017. That's why the broader market, isn't doing perhaps as well as the earnings are doing this year, and I think you're going to settle into something more sustainable after that.
You talk about this being real because we're seeing sales growth. It's not just the juice from the tax cuts. Should investors be asking whether or not, though, in some of these earnings reports that we're seeing sales that would have taken place in the future being pulled forward because of the threat of tariffs and trade wars, or is that not relevant?
Yeah, I have to say that the full measure, in my opinion, of how well this cycle, how long it lasts, because I'm not particularly convinced we're as late in the cycle as some people think. It's possible, but the full measure of the efficacy of these tax cuts will be capital spending. Because capital spending has been virtually non-existent since the Great Recession. You've had a lot of financial engineering as opposed to people investing in their own companies. If you get the capital spending, you get productivity. Productivity keeps unit labor costs low, keeps the Fed out of the way, and you create wealth through productivity. So to me, the tariffs are an issue, and I think part of this, we all have to just get used to this, is the way a commercial real estate guy does trade. which is very broad, right? It's not just trade. You're also talking about contributions to NATO. It's all part of one big omnibus negotiation. It makes people feel very uncomfortable. But I wouldn't lose sight, it's a long-winded answer to your question, the fact that the fiscal stimulus is enormous. And I'm not sure people, you're looking at $400 or $500 billion in repatriated corporate profits this year alone.